Politics from U.S. elections, prose from COP26, and a poetry haiku from the Federal Reserve. This is Bloomberg Wall Street Week. I'm David Westin. This week, former Bank of England Governor Mark Carney on enlisting the banks to fight climate change.
They see a lot of offensive opportunities and only more to come in the future.
Former Treasury Secretary Larry Summers on the Fed's calm attitude toward inflation.
I think we're taking a real risk that we're setting up for a very serious problem.
And Lazard CEO Ken Jacobs on how his business is changing because of ESG.
On the asset management side of the business, absolutely. That's changing rapidly.
Just about everyone got their licks in this week, from U.S. voters telling the Democratic Party to think again, as described graphically by Democratic strategist Howard Wolfson.
I mean, it was a bloodbath.
To European Commission President von der Leyen telling the world it needs to pick up the pace on climate action.
We all must speed up our race to net zero. We're running out of time.
But in the end, it all came down once again to the Federal Reserve and its chair, Jay Powell, who went out of his way to calm the markets, announcing finally that the Fed would begin to taper its bond buying program, but that it is in no rush to raise rates.
Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate.
When we heard from Chair Powell on Wednesday, he said our monetary policy ultimately depends on the labor market. And then on Friday, we got surprisingly strong numbers for jobs growth, adding over 530,000 in October and revising up the numbers for September to over 300,000. The markets took the week overall as pointing to risk. The S&P was up 2%, the fifth week in a row. That's the longest streak in over a year. And the NASDAQ rose even more, up 3%. But all that equity action didn't hurt the demand for bonds, as the yield on the 10-year fell 6 basis points to end under 1.45%. To give us an investor's perspective on all this, we welcome now Afsaneh Beschloss. She's founder and CEO of RockCreek. So, Afsaneh, great to have you back with us, always is. So give us a sense. It sounds like right now we can have our cake and eat it, too.
It's great to be with you today, David. It was really interesting because what Chairman Powell said was exactly what the markets expected, right? And he said what we had been waiting for a long time with the 15 billion tapering every month. At the same time, he made it quite clear that other market expectation that, when tapering is done in July, we would probably start having the rate increases may or may not be the case. So I think in terms of eating our cake, absolutely, we can continue having growth. We can, as you said, we had the yield curve steepen. We had the markets, up 6 times in a row. That was quite exceptional. But I think what a lot of people did not maybe pay a lot of attention to is what happened over in the UK with the Bank of England, which has, I think, some relevance to what Chairman Powell may be having in mind as we get into next year. And that was the markets expected interest rates to be increased in the UK, and that did not happen this week. And a lot of people lost their shirt. And I think what Chairman Powell is saying is he does see the one condition of inflation where he expected it to be, which is more than 2%, and it is. And there are lots of conversations whether it's going to be higher or not by a lot because of the supply chain problems. But more importantly, he and I think in the past, Janet Yellen are 2 Fed chairmen who have really, really talked about not just the numbers that we see, like the ones you mentioned, the 530,000 today, which, by the way, had 200,000 women in it. And that's very important because women are starting to go back as schools are opening. But a lot of people are still sitting on the sidelines. And he talks about maximizing employment. So he's looking at it much more from a maximizing employment, looking at lots of different dots. And also, we should really watch what they're saying much more carefully just like I think we were surprised by UK. If you let me, I just was, reminded of a Stan Fisher quote because he gave this great lecture yesterday at MIT. And Stan, who was a former Fed vice chair, once said that central bankers are, it's a dangerous place to be a central banker because they can print money. But he also said central banking is something like a pointless painting. You have all those dots of data and you're trying to figure out what on earth is the picture. Yeah, and I think that is the problem.
And Afsaneh, when you talk about those people on the sidelines, it points to participation numbers, which are stubbornly not going up particularly well. But if you're an investor, it's not just the yield, it's the real yield. You have to take into account inflation. And one of the questions I have is, we had Chair Powell masterfully keep the markets nice and calm. Is that really what he wants to do? Is he going to fight inflation by doing that? Because actually financial conditions actually loosened rather than tightened when he said he would taper.
They did, and I think he will be much more careful. But again, this focus on what he has said very clearly, employment, I think, is sort of really, really up there for him. And so he will be watching inflation at the same time. But if we do think that with the supply chain problems that are there, we will have less of a problem. One, because growth rates will be lower next year in the US, in the rest of the world, in Europe, and in China. You may not have as big a problem. And so your real yield, which is what you're talking about, may actually do better because inflation may start going the other way around. So I think that's sort of the way he's implying his thinking is, and that's the way we actually think at RockCreek too.
So as a practical matter, I hear from a lot of people, it's just hard to find yield, period, because there's so much money in the marketplace at this point. We had, of course, the COP26 talks that you were very involved in over in Glasgow this week. And I wonder, as an investor, what are the opportunities there with climate? Because I hear a lot of lofty goals being announced. At the same time, I'm not exactly sure how it's translating into the real world of investing.
By the way, one point we should mention is, I think, maybe there have been others in the past I don't know about. Jay Powell may be the first Fed chairman who, before he joined the Fed in his earlier role in the Fed, was actually investing in sustainable climate-related investments. So I think it's a point that he doesn't talk about too much, but interesting. In terms of investments, I think to look at the positive, obviously there is the most important point that has been highlighted in COP26, which is finance is key. Asset allocation is key. There's so much asset sitting on the sideline right now, as you said, earning negative returns in fixed income. So if you have some, if you can move those assets to positive returns and in a sustainable economy, it will be very, very helpful to everybody. And we at RockCreek have signed up with a number of the alliances in particular. But as you said, it's not signing up and committing that matters. It's actually what you're going to do. And we saw with the Oxfam report, right now, the 1% top, most wealthy people are responsible for more than 16% of the emissions. And that number is expected to go up in the next 10, 20 years. So going back, I'm positive about opportunities. I'm really concerned it's going to be much, much slower, David, in terms of putting them into action and maybe making people think they have to get to net zero without giving them a transition plan of how you get to net zero is a big problem, which nobody is really talking about.
I guess one of my questions, Afsaneh, is, if I can put it this way, when we talk to about all this capital going into green investing, is it a push or a pull? And by that, I mean, are the opportunities so attractive that people would be idiots not to go into it? It's just so attractive. Or do they need a push, whether from governments or otherwise?
I think there is definitely a lot getting done as we speak on the technology end, creating new batteries that will have longer life, more storage, and also potentially other forms of energy. So there's that going on. And if, as we've seen, those could have very, very high rates of return. In fact, David, some of the highest return investments in the last 12 months were in venture in clean energy. So there's certainly a return perspective that we should not forget. At the same time, solar energy is very cheap now. So if you invest in transmission or development in solar, the returns are not going to be high. So the question is, so long as they're positive, is it higher than the negative returns that many, many bondholders are holding? And can the financial system create tools that allow people to go into it? So going back to your point, I think it's a pull and a push. The only thing that I have found has changed in the last year, but particularly the last few weeks around COP26, is a lot of universities and endowments have changed their tune, and they are truly looking at how they can improve the endowment management, which was very far behind in terms of climate, but also bringing in their scientists and people who are running the university operationally to see how you run a university on net zero. And David, they still are looking for answers. So I think a lot of work has to be done on implementation, not just pledges.
Just very briefly here at the end, Afsaneh, can we get past energy to things like green steel and green concrete?
I think there is hope. I think we will need a lot of investments going into those areas. I'm very optimistic about those areas. I've seen some research going into it that will make it positive. So you may be asking the wrong person.
Are you disappointed we didn't do away with coal?
I think it's really disappointing that the US in particular did not sign up for that. And while we had a lot of smaller countries like Vietnam sign up and Indonesia sign up, you had the US not sign up. So that, alongside, of course, China, who did not even appear at the meetings, is very, very upsetting to the market. Yeah. We all know there's a shortage of energy as we speak, but we need to find jobs for the coal, people producing coal, move on.
Some work left for COP27. Okay, thanks so much to Afsaneh Beschloss. She's RockCreek Group Founder and CEO. Coming up, we talk with former Bank of England Governor Mark Carney about his project to enlist financial institutions in the quest to slow global warming.
In many respects, it's a watershed. Wall Street and the global financial sector has stood up and said, look, we'll put capital behind these solutions.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The COP26 meetings were dominated, of course, by heads of state this week, but a lot of the big news came out of the financial sector and a huge effort of the financial industry to really support the goals of zero emissions. Those efforts were led by Mark Carney, the former governor of the Bank of England. He's now vice chair of Brookfield Asset Management and, as important, a special envoy of the United Nations. So we welcome now Mark Carney to Wall Street Week. Thank you so much for being with us today. Start with exactly how the world changed because of those huge initiatives. So I understand you have 450 institutions, something like $130 trillion in assets represented. But if I work at one of those institutions, an asset management firm or a bank, how are the decisions I make today different from the ones I made yesterday?
Well, first off, David, thank you for having me on. I love the show. You're an absolute institution, and I'm going to take it, if you will, from a Wall Street perspective. And what it's going to mean for people working there, and a number of them are already doing this, but it's going to go across the organization, is they're going to look, when they're making a loan or they're making an investment, they're buying a bond, even trading a derivative, they're going to start taking into account the underlying credit, the underlying company. Where is it on the transition towards net zero? Because after all, we're here in Glasgow. The objective of 195 countries is to get to net zero greenhouse gas emissions. And so this is going to become, a competitive advantage for companies that are moving faster towards that, companies that are part of a solution. And it's going to be a challenge for those companies who haven't. So this lens on climate and climate competitiveness, if you will, is going to be applied across virtually all assets. And that's going to be part of the skill set of the individuals who are making those portfolio decisions.
So you know this industry so terribly well. Distinguish, if you would, defense from offense. And this is what I mean by that. It's one thing to say, if I'm working for a bank or an asset management firm, I'm going to really shy away from some of the fossil fuel companies. I understand that. I'll call that defense for a moment. But does this encourage companies to go on the offense, for example, to invest in green steel?
Look, David, absolutely. And that's the big shift here, I think, that we've been aware of the risks around climate, and the most obvious ones are, when New York gets hit by an extreme weather event and there's big property losses, or supply chains are disrupted by another event on the other side of the world, and we have those effects and we have to manage those. But there are huge, huge opportunities in being part of the solution. And so the offense here is very, very broad. Of course, it includes, and in my professional life, I do a lot of this at Brookfield, one of the largest renewable producers in the world. It includes building out wind, solar, hydro, eventually hydrogen and other technologies that produce electricity with no emissions and are part of very much central to our future. But almost as interesting and really more valuable is going to companies that have high emissions today. You rightly mentioned the steel industry, or the auto industry, or the cement industry, the building industry, commercial real estate, others, and helping them get emissions down. Now, it takes a lot of capital in order to do that, but it's going to pay off in terms of a huge amount of value. And so on the range of solutions and investment opportunities here, you have technologies that are just going to take existing activities of, whether it's HVAC, heating, ventilation, cooling in buildings, or grid optimization for electricity grid, and just get the emissions down from existing plant. Next to that is putting in place new technologies, new investment that itself gets emissions much more dramatically down. And then farther out the risk spectrum are those technologies that'll be very much part of our. I referenced green hydrogen a moment ago, and that would be a classic example. The more extreme breakthrough technologies, I put it in the venture capital camp, are technologies around, for example, direct air capture, sustainable aviation fuels. So the whole range of the investment spectrum is available. And look, your question is very on point. This is much, much more about offense. It's much, much more about getting capital to solution. And candidly, that's why we need something like $130 trillion to be focused on addressing this issue.
So speak to those investors. As you describe this, what we're calling offense, investing in things like green steel and the like, do investors have to get used to lower returns as a practical matter?
No, I don't think so, and certainly not on a risk-adjusted basis. One of the things, now for a moment, David, I'm going to speak about defense, unfortunately, which is one thing investors increasingly will need to do is think about terminal value, think about where certain assets are going to lose value and potentially lose value quite rapidly because they're not decarbonizing fast enough, or they're just not suited for a low and zero carbon economy. You referenced part of the energy sector, fossil fuels. There's elements of that which will not be there, or certainly can't be there if we're going to get to where we need to go. So investors need to look at that.
Mark, you are spearheading, if I could put it that way, a major transformation, a transformation the likes of which I can't think of alike in history, frankly. You can't have that big a transformation without some costs along the way. There's no such thing as a free lunch. You say perhaps returns will not be reduced in this area. What about costs? Because as we make this transition, there's got to be disruption somewhere.
Yeah, look, David, transforming the energy system, it's better to start early in order to have a smooth transition. But but we haven't started early. Let's be candid. We've left this very late, certainly for the 1.5 degree objective. So there needs to be a very rapid ramp up in renewable power. But at the same time, we need to get it right on the fossil fuel side and have those bridge fuels that are necessary in order to keep the lights on, literally, and keep industry humming as we build up the other side. And there's lots of ways to get that wrong, to have too little too early and have the type of volatility we've seen in energy markets. That's one risk in terms of a bump. Another risk is, look, in terms of this decade, there is a very large number of highly economic technologies where the real issue is just rolling it out at scale. Slightly easier said than done. You got to get planning permission. You need the right companies, et cetera. But it's not yet. It's not technology risk for what we need to do to get emissions down sharply this decade. In the 2030s, it is some technology risk. There will be a lot of bets on, I suspect, on elements of hydrogen that don't work out. There will be some big venture capital effectively bets on capturing carbon from the air, direct air capture of carbon that don't work out as the nature of any VC bet. So there will be volatility, and you're right to emphasize the scale of it. Although, last point, relative to doing nothing, which is more or less the strategy the world has been pursuing up until recently, these bumps are nothing compared to the cost that would come.
Yeah, a really powerful point. Thank you so much to Mark Carney. He is the Vice Chair of Brookfield Asset Management. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now to take a look at what's coming up next week on Global Wall Street.
Well, David, this week the spotlight is back on China tech. Tencent earnings, they could confirm that the worst is over of the government's crackdown. Meanwhile, Alibaba puts on its Singles Day event. Now, this is bigger than Black Friday and Cyber Monday combined. The festival theatrics, though, looking to be a little bit more subdued this year. Still in China, there are more debt deadlines facing property developer Evergrande. Plus, we'll have the latest from the APEC Leaders Summit. To Danny Berger in London now.
Thanks, Annabelle. Well, it's the second week of the COP26 climate conference in Glasgow. They'll be wrapping up negotiations on Friday. They'll likely release a text of those negotiations where we're expecting them to reaffirm some of the Paris Agreement climate goals. We also have meetings in Brussels next week from both ECOFIN and Eurogroup meetings. Then there's a large private equity conference in Berlin that takes place all next week. We'll have all of the typical private equity giants there, and Bloomberg will be live on the ground for it. It's also another week of many earnings. You have about 1/6 of the stock 600 in Europe reporting next week. It includes pharma giants like Bayer and AstraZeneca, as well as some insurance companies like Allianz and Munich Re. Now let's get over to Romain Bostic in New York. Romain.
Thanks, Danny. A major milestone ahead that could add fuel to the economy. The United States will open its borders to vaccinated foreign travelers on November 8th, marking the biggest easing to travel restrictions imposed during the COVID crisis. Elsewhere, there is some economic data to keep an eye on, including inflation numbers. The average estimate of economists surveyed by Bloomberg sees the fastest year-over-year increase in prices paid by U.S. consumers since 1991. I'm Romain Bostic in New York. Back to you, David.
Thanks to Annabelle, Danny, and Romain. Coming up, how do all those zero emissions goals translate into real actions by the people who are doing the deals and managing the assets? We talk with the chairman and CEO of Lazard, Ken Jacobs.
I would say most of asset management is investing defensively around ESG, and I think that's going to shift over time.
This is Wall Street Week on Bloomberg. Zero carbon emissions. It was all the talk this week at the COP26 meetings in Glasgow, with European Commission President von der Leyen urging faster action.
We all must speed up our race to net zero. We're running out of time.
And President Biden saying the United States will lead the way.
The United States is not only back at the table, but hopefully leading by the power of our example. My administration is working overtime to show that our climate commitment is action, not words.
But if we're going to have any hope of making real progress on emissions, it will take more than governments. It will take a massive effort of the private sector. Bank of America's Brian Moynihan says banks like his are feeling the pressure.
There's a lot of pressure on banks because our clients are demanding this. Our investors are demanding this. The politicians, the world's demanding this.
And Luke Ellis of the Mann Group says that with more guidance, the private sector, and especially hedge funds like his, can help get us where we need to go.
The clearer the roadmap we can get from politicians about what they're going to do, the more that the private capital markets can actually make the transition happen. In the end, there's a lot of good words are going to come from government and regulation is going to come from government, but a lot of the capital that's required to make the transitions has to come from the private markets.
Lazard Frères is on the front lines in arranging acquisitions and mergers, also in managing nearly $300 billion in assets. So when it comes to figuring out how the lofty goals of COP26 may translate into the real world, there's nobody better than Lazard Frères. And we're joined now by the chairman and CEO of Lazard Frères. He is Mr. Ken Jacobs. Welcome to Wall Street Week. Good to have you here.
Thank you. It's a pleasure to be here.
So we've heard these lofty goals. Everybody is signing up for them. But what does it mean in the real world? As you're doing deals, as you're managing assets, is it changing what you do?
On the asset management side of the business, absolutely. That's changing rapidly. On the advisory side of the business, which is arranging mergers and acquisitions, that's on the come, so to speak. We're seeing the beginning of it, but it's not quite there yet. Let me speak to the asset management side to begin with. One has to step back and realize this has been in play now for several years. The first thing that happened is the core demographic that drives activity in the economy started spending their values. That was, couple of years ago, 3, 4, 5 years ago in the United States, longer in Europe. Over the last couple of years, it has shifted now, so that same demographic is starting to invest their values. And that's playing through in the asset owners, and it's really having a big impact on the asset management business.
So when you talk about investing in assets, is it defense or offense? And by that I mean this. It's one thing to say, I don't want to invest, for example, in a fossil fuels company. Okay, I get that. But what about affirmatively investing in a green steel company?
I think in the beginning, it's going to be defensive because at this moment in time, there's very little that kind of ties green performance, whether you are your emissions policy, your social policies. There's very little that actually ties that to performance in the stock market or cost of capital. That's at its very early stages. But scoring companies is there. So I'd say at this moment in time, we're probably doing, I would say most of asset management is investing defensively around ESG, and I think that's going to shift over time.
We heard from a former Vice President Al Gore this week saying that we have something of a, I think he called it a climate subprime crisis coming, because there's trillions of dollars in assets in coal and in other fossil fuels that may not be worth actually what we think they're worth because they'll never get used. Is there a looming problem with that?
In the long run, yes. In the short run, in the medium term, we're going to have many ups and downs. A year and a half ago, when oil was trading at a negative value, who would have predicted close to $100 oil price a year and a half away? So I think what we're going to see is a lot of what I would almost describe as uncertainty and outlier kinds of experiences over the next several years. I think in the long run, he's probably right. As we make that transition to the energy transition to renewables and to more green types of energy, that will happen. But in the short and medium term, we could have a lot of ups and downs.
So what do you do as an asset manager in that circumstance? Because we have a short-term supply problem, for example, natural gas in Europe. And we've seen the prices spike up. And we've seen energy companies' stock actually go up. So in the short run, you actually might be able to make some money because the market may have overly discounted the value of those stocks.
Yeah, well, I don't think it's as black and white today as that asset managers can't invest in oil and gas and energy stocks. I think we're slowly, maybe even more rapidly than some would like, moving in a direction where it becomes less attractive to do that. But at the moment, there's still ways for people to invest and make money in the short and medium term on those kind of spikes and movements in price.
At this point, are there enough really attractive alternatives on the green front? Now I'm talking about the offensive part, yes. Whether it's solar or whether it's new technology. I've talked to some people who manage a fair amount of money who say, you know what, even though I want to invest a lot of money, there aren't that many good deals to be done.
Well, I think that's going to, again, I think it's going to evolve. As you start to build in the incentives, both from the standpoint of where capital goes, and I mean, if as an example, there's a real incentive for people to invest in green projects, then the cost of capital for those projects goes down, and those projects become more attractive to invest in. And I think we're going to see more and more of that as time goes on. Also, the investment that's taking place in technology, everything from storage to wind, solar that have taken place over the last couple of decades have made an enormous difference in creating opportunities in this area. And I think that's just going to continue.
So as you look at possible assets to invest in, how many things do you find that you can invest in that really have attractive returns? Do you have to get used to taking a lower return as a practical matter to accomplish some of the ESG goals?
Not necessarily. Again, one has to look. On one hand, you can look at what's happening in the electric vehicle space, and you can see Tesla at a plus $1 trillion valuation, Lucid and a couple of the other car manufacturers at $60 billion. This is an area where there's just been enormous investment and just spectacular returns for people over a period of time. I think we're going to see opportunities here for a long period of time, as long as people believe we are really moving to, that we're really on a path for energy transition. If, on the other hand, this reverses itself, which frankly I don't think is going to happen because of this, what I would call this demographic, this economic demographic that's really pushing this, I don't think it's going to reverse, but should it reverse, it changes things. But as long as people think we're on this path, then these technologies, then there's going to be an enormous investment in these technologies. Because the payoff is going to be huge.
That raises the question of where we are on the path. I mean, all of us have learned maybe the hard way that if you can't measure, you can't manage it. So
Yes.
How do we measure this? How do we know where we are on that path and whether we're making progress, even if we really want to badly?
Well, I think there are some indicators. 15 years ago, one would have, or before the financial crisis, when oil and gas prices were spiking in 05, 06, one would have said there's no point in investing in renewables. How do you compete in geothermal? How do you compete in solar? How do you compete in wind? And prices have come down 70 to 90% since that point in time, which have made all of those technologies at a much lower oil price, in fact, and a much lower natural gas price competitive. Today, those technologies are very competitive, and that's the kind of investment that's going to take place. You come down the cost curve, it drives that. We're likely to see that over the next decade or two around hydrogen. We're certainly like to see that. We're likely to see that around storage over the next couple of years, over the next decade as well.
So that raises the question, in my mind at least, about the government. Because if the markets are taking care of it, maybe we don't need the government to do anything, or do we need the government to set some of the rules for us?
Well, I think there's two places the government can be really helpful. The first is in setting the rules. There are going to be standards around disclosure that are just going to be necessary to create a level playing field for companies and also for investors. And I think the SEC is moving, it appears to be moving aggressively around that. The second, and along the same lines, the accounting standards around disclosure are going to be very important as well. So some standard setting around that is really important. The second thing government can do is it can pick a few areas where no one else can invest efficiently to make a difference. Just as an example, in the infrastructure bill, there are two areas that the Congress is focused on and the administration is focused on. One is around EV infrastructure, and the second is around the grid. Those are two examples where if you can accelerate that, or you make that work, then it makes the transition from gas vehicles to electric vehicles just much more efficient, much quicker, because electric vehicles, of course, need to worry about the EV infrastructure, and ultimately, the grid is going to become even more important than it is today with electric vehicles. For an investor, how important is it that there be international cooperation on this? I mean, because otherwise we could have countries competing with each other in a bad way. Absolutely. There's got to be some standards, because you can imagine a scenario where one geography, let's just say the European Union decides, look, we're going to start taxing carbon differently on products coming from the United States if they don't have the right policies, or from China if they don't have the right policies. So you can end up in a pretty protectionist regime pretty quickly if you don't have common standards globally. You said when it comes to ESG for Lazard Frere that the asset management side is a little bit ahead of where the merger advisory side is. Where is the merger advisory side? Well, what I would say first of all, on the asset side, we've made huge investments to really position ourselves in this area. On the advisory side, we're doing the same thing. We're launching a climate center in December, and one of the first areas we're going to be focused on is the impact of the energy transition on cost of capital and ultimately stock price. There's very little evidence in the market today, or literature in the market today, that really takes and ties those two together. That's going to be critically important in terms of understanding how to value transactions that are either carbon accretive, carbon dilutive in an M&A context. And I think that's going to happen over time.
Ken Jacobs, Chairman and CEO of Lazard Frères. Thank you so much for being with us on Wall Street Week. Coming up, we wrap up the week as we always do with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin, and we turn once again this week to our very special contributor. He's Larry Summers of Harvard to take us through the week. First, let's start at the end of the week, Larry. We got the jobs numbers out for the United States, better than expected, pretty robust, not just for last month, but also revising for the prior month. What do you make of these jobs numbers?
Look, it fits what I've thought for a while now, David. We've got a very, very strong economy on the demand side, and not a very strong economy on the supply side, and that's risking an overheating. You saw a lot of job creation. You didn't see an increase in labor force participation. You saw a rapid average hourly earnings figure, but if you adjusted for the fact that most of the people coming back were in leisure and hospitality, where wages are relatively low, it was an even stronger wage figure. I think we're still not running policies that are consistent with the reality of the economy. The reality of the economy is that we've got an interest rate far below the neutral interest rate, and we've got a tight labor market. And that's a prescription for rising inflation, not a prescription for falling inflation. So I continue to be very concerned about the outlook going out a year or so as the economy starts hitting supply constraints and hitting them hard, given all the pressure on demand.
Larry, I wonder if there's a connection between two of the things you referred to, the participation rate on the one hand and the increase in average hourly earnings on the other. Because we've been saying, well, the participation rate went down from the pandemic. It's come back some, but it's not nearly where it was before. At what point, as that continues out, does that become a structural change that actually could have longer-term effects on inflation, particularly wage inflation?
So I think there are 2 points, David. The first is that until 2017, the Fed thought the normal unemployment rate, the natural unemployment rate, was 4.7% or more. So we may well just be there looking at the level of unemployment, and it's clearly headed down from here, not up from here. With respect to participation, I don't think anybody can gauge it. But if you take more mental illness, if you take some concerns as people reassess their lives, as you take a super high level of structural change in the economy, as you take some people because of their fears of COVID or their distaste for mandates moving away from work, if you take the early retirements that probably aren't going to be reversed, if you take the more generous child care benefits and apply the estimates the progressives have traditionally used, that's likely to have some discouraging effect on employment. If you take all that together, I don't think we've got a strong basis for thinking that participation is going to rally in a major way. It might happen, but for that to be the major planning assumption seems to me to be taking a big risk.
So, Larry, hook that up, if you can, with what we heard from the Federal Reserve this week, and particularly from the chair, Jay Powell. He certainly seemed to say in the news conference that really, when it comes to the question of tapering, he's begun, but particularly rate hikes, that's going to be determined by what happens with the labor force. Is he right about that? And is it possible for him actually to be too gentle in the messages he's sending to the markets? Because certainly the financial conditions did not tighten at all.
Look, what the Fed controls is financial conditions. If you look at financial conditions as measured by real interest rates, if you look at financial conditions as measured by asset prices, they are looser than they were before Jay spoke on Wednesday. They are looser than they were a month or two ago. We've got rising inflation, and we're not tightening financial conditions. That's why I fear that we are on a risky course. Now, the argument that thoughtful people like my friend, former classmate Paul Krugman make is that there's some risk aversion principle that we've got to do this because it would be so catastrophic to run a recession, and inflation is a manageable problem. I agree that we've got to guard against risks, but here's my view. My view is if we let inflation accelerate, there's almost no proven ability of the central bank to engineer a soft landing. And so in order to squeeze out an extra bit of hoped for labor market tightness, I think we're taking a real risk that we're setting up for a very serious problem. You know, if you look ahead of you and you see that there might be all the traffic stopped, you start braking your car as early as you can, even if it means that it's going to slow you down in the event that there is no traffic jam. And that's, I think, the right way to think about the central bank's problem right now.
Larry, another big development through the course of the week was with respect to the bipartisan infrastructure bill, as well as the so-called Build Back Better plan. It's not quite there yet. It's not finalized, but we have a pretty good sense of where it's going. What do you make of what we're seeing, both on the what we're spending side and how we're paying for it side?
Look, I hope we get this done. I hope both bills pass, the bipartisan infrastructure bill and some version of the so-called reconciliation bill. There's sure a lot of effort going into building better, build back better, and I hope it works out. I also hope people are going to keep a very, very close eye on this, since at the very last stage, that's when abusive provisions or misprovisions are sometimes put in. I'm glad to see that the provisions on SALT deductions look like they're being modified somewhat. It would have been a real tragedy, David, I think, if the provisions had ended up being written in a way where people in the top 0.1% of the income distribution got a substantial tax cut. I think we're moving towards fixing that. But look, these are investments that our country should be making. It's also not too early to say that it's not the amount of money you spend and the nobility of the cause you spend it on, but it's how well you spend the money that matters. Are infrastructure projects going to produce a better infrastructure, or are they just going to help the businesses that provide infrastructure services? It's going to be really important, both in terms of the effectiveness of the investments and in terms of the American people's confidence in government, that this money be spent well as being spent on a significant scale.
Larry, one last one. Last week, you and I talked about the COP26 talks, which were upcoming in Glasgow. We've now had them. You expressed some concern, even doubt, last week that they would be able to do enough to really get us on the course we need to go. Did they?
I'm still worried, David. You know, I learned as a fundraiser that when people wanted to say a really polite no, what they would do is talk about a much longer horizon and a much more ambitious goal. And I felt like there was a fair amount of that going on in Glasgow. And I'd like to judge things a little more by what people are actually going to get done and committed in the next 5 years, rather than the aspirations they're going to set for decades from now.
It's such an important lesson. Just briefly here at the end, what do we need to do to have concrete things to be done in the near future?
I think how rapidly we're moving to, in a very supportive way, replace coal-fired power plants with renewables is going to be an absolutely critical test. I think globally, we are still spending trillions of dollars on fossil fuel subsidies. And the single most important thing I would be looking at is not the credits that we give to renewables, not the penalties we impose on fossil fuels, but just the pace at which we reduce those fossil fuel subsidies.
Such an important way to look at it. Thank you very much. That's Larry Summers. He's our very special contributor right here on Wall Street Week. Coming up, one more thought. When is the Magic Kingdom not so magic? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Hotel California moves to Shanghai. None of us anticipated how long this COVID thing would last. Certainly, President Trump didn't when he talked about getting rid of it in April of 2020.
Looks like by April, in theory, when it gets a little warmer, it miraculously goes away. I hope that's true.
But coming up on 2 years later, it feels sometimes like this will never end. We've now lost over 750,000 people here in the United States and around 5 million around the world, while the economic disruption just continues right to the present day, as Fed Chair Jay Powell admitted again just this week.
We were on a path to a very different place. Delta put us on a different path.
And inflation? Well, Kristalina Georgieva of the IMF says it's really just a vaccination problem.
Preferably, we should see tempering inflation. And how can we do that? Well, focus on reducing this divergence. Vaccinate the world so we can see production everywhere stepping up.
Nothing could compare with the loss of life and the economic dislocation. But let's be honest, there's also the sheer annoyance of still having to deal with it all. The wearing the masks that leads airline passengers to become violent. And as Ed Bastian of Delta tells us, get banned from traveling permanently.
We've had a few incidents, not a lot on Delta, but anyone that doesn't want to wear a mask and they're on board, we give them the option to either wear the mask or they're taken off the flight and put on our no-fly list. And we've had about 2,000 people that we've put on the no-fly list, the permanent no-fly list, over the course of the pandemic.
But as frustrated as you might be, you can take heart. You probably don't have it as bad as 34,000 people who went to visit the Disney theme park in Shanghai. They all went with their small children for a magical day, but one person tested positive for COVID. They closed the park, wouldn't let anyone leave until every single one of the 34,000 people had been tested. It took until about midnight. You can imagine what that would have been like with your 5 or 6 year old child. And to add insult to injury, in the end, no one else tested positive. I guess better safe than sorry, but like the Hotel California, you can check in, but you can never leave. At least not until you've had yet another COVID test. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.